New home construction cancellations are up. And so is that an indication that we should be exiting any of our home builder stocks in this environment? That's what I'm going to cover in this video. So guys, smash that like button, subscribe if you're new, and if you're one of the cats that watches this channel, drop a meow in the chat. You're watching More Money, let's get it. What's up guys, and welcome back to the channel where the goal here is to help at least 1,000 people achieve financial independence much sooner. And this news is very interesting. A lot of value investors are paying attention to this. You can see here that new home cancellation rates have actually ticked up to almost 15% as of June of 2022, as reported by Redfin. And what does that really mean? Well, you can see here in exhibit number 2, that sort of like 14.9%, it's actually being reported as 14.5% by John Burns Real Estate Consulting Group, which is close enough. But, you know, from a directional perspective, you can see the last time new home construction cancellation rates were as high as they currently are was back in the early days of the pandemic. Before then, we haven't seen those levels in the near term. And where the cancellations are occurring tells a big tale. Notice how Texas, which is one of the areas that has been growing because a lot of people from New York and California have been migrating into Texas, buying homes, especially in Austin, which has now become an expensive area, but also the Dallas-Fort Worth area, and to a lesser extent, the Houston area. You can see that they've had the highest jump in number of cancellations at 27%. The one that's interesting to me that remains low is actually Florida. So their cancellation rate is only 9%, despite the fact that Tampa and Miami have had one of the highest price increases throughout the US since or post-pandemic. So it's very interesting, but it also speaks to the value proposition in that state. But despite all that news, it's very interesting how the home builder share prices have reacted in the last month. You can see here, Lennar's Corporation's shares have actually jumped almost 13%. LGI Homes shares have actually increased more than 17%. TriPoint have actually increased close to 5%. And so what exactly do I think is happening? We're getting worse news, but the share prices have actually been outperforming the market as a whole. The market continues to decline, but the home builders are up, especially in the past month. And so why is that happening? Well, I believe that that's happening because you have a situation where so much pessimism has been baked into the share prices of these home builders that any bad news that's not worse than what people were expecting will actually take the share prices up. And so I think that's what's happening. And a better way to show you this visually is by showing you the tracker that the Patreons get access to. So this is the top 15 or so names. Notice that of the top 15 or so cheapest names as a share price of their intrinsic value, home builder and related stocks have really been beaten down, and they're now crowding the top of the undervalued opportunities. So you can see Dream Finders Homes over there, TriPoint Homes is up there, Zillow Group is up there, and LGI Homes is up there as well. And I believe I personally own all of these names, just in full disclosure. And what I really wanted to do is look into one of these names. So my favorite home builder is actually LGI Homes. Look how I'm modeling this name out right now. So I'm actually forecasting a 10% decline in fiscal year 2023 in sales, and then another 10% in 2024, another 10% in 2025, and in 2026 as well. So effectively what I'm saying is that this home buying surge is pretty much going to reverse itself over the next few years, but it's going to be supported a little bit by declining commodity prices and just a low inventory amount in the US. So there is a little bit of pessimism and a little bit of optimism built into those numbers, but effectively it takes us back to close to those pre-pandemic numbers. And so what does that mean for the valuation? Well, you can see here, using a terminal multiple of 10 times earnings, I'm valuing the company at approximately $143 per share. That, compared to its current share price, is trading at now approximately 67% of its intrinsic value. So it's less cheap than it was when I was talking about it a couple of months ago, and that's okay. But here's something that you got to know. There is some upside to my valuation because the debt on the balance sheet is secured by the inventory And in calculating excess inventory, I only used 50% of the inventory book value to be conservative. But in all fairness, you could probably use 100% or closer to like 75% of that inventory value. So there is a little bit of an upside here. And remember, when they sell that inventory, they don't just sell it for the book value, they sell it with a margin on top of it, which is sort of like your gross profit margin. And so there is more upside here than I'm sort of valuing it. And so in a worst case scenario, if they're going to liquidate sort of the inventory on the balance sheet, you can get a little bit more than what I'm valuing it for. But that's okay. I want to be conservative, and so I leave the valuation at that. Now, here's the other question. We valued this name at approximately $145 per share. But now, as a buyer, especially as a value investor in this environment, you might be thinking, okay, I actually would not want to touch this name. Despite it trading under my intrinsic value calculation, I don't want to touch it for anything over, say, $75 per share. So half of its intrinsic value. Well, that's where the cash secured puts come in. And so what exactly is the yield for the cash secured puts? Well, you don't have to go and look. I actually did the work for you. And I leave this in the Patreon model tracker for the Patreons anyways, but you can see here that if you want to sell the cash secured put for this February 17, 2023 strike date, if you can catch that $8 per share ask price, which you might be able to catch, you might not be able to catch. It just depends if you get lucky. Sometimes I actually get higher than the ask price, so it just depends on the day, to be honest. But if you can catch that $8, you can catch a 70.5% annualized yield. And that would give you a net purchase price of somewhere in the $60 per share range. So that's really good. Now, if you wanted to go a little bit lower and you wanted to use a strike price of $60, well, if you can catch that $5.50, you can actually generate a 15% annualized yield. So I'm probably more comfortable with that $75, but you guys might be more comfortable with that $60. But that $60 is well below that intrinsic value calculation of $145 per share or so. And it is well below that approximate $100 per share that the shares are currently trading at. So you get a lot of margin of safety using those cash secured puts in this environment while still generating a healthy premium. Now, this is not a endorsement to invest in it. This is just the research that I love to do and share with you guys on this channel. And if you want access to all the models, including the LGI one that I just showed you, and all the models that support all of the other valuations that the Patreons get access to, you can get access to all of those at the lower tier of the Patreons. And if you want to join us for a live epic presentation where my very best work is reserved for, you can join us on a live Zoom call at the higher tier of the Patreon level. And like I always say, if you decide to try it out and you think that it's not for you, no problem. I'll completely refund your first month's subscription because that's how much I believe in the product. And at the end of the day, I don't want you to pay for anything that you don't find value in. So happy to refund that money. Now, one thing that you guys do got to pay attention to is I actually think that a home purchase slowdown is expected to continue as we've sort of entered this recession. And I actually talk about the indicators that suggest that we are now in a recession. And you can get to that video right here.